So, good morning or good afternoon, dear ladies and gentlemen. It is my sincere pleasure to welcome you to today's webinar, hoping that we do still find you all well and going strong throughout the ups and downs of life in times of COVID-19. Whatever our altered normality with or hopefully beyond COVID will look like, we already know for sure that the pandemic caused major disruptions to the economic environment, affecting businesses around the globe and across all sectors. As one of the consequences, it is now necessary for multinationals to revise their transfer pricing models in order to make sure that the arm's length prices are properly documented and do support the changes caused by the impact of the pandemic. The OECD has issued guidance on how to deal with the transfer pricing impact under these unprecedented circumstances, and so did various Asian countries. In the course of this webinar, we will highlight the impact of COVID-19 on the arm's length pricing and explore how your business can deal with this impact. Though we probably all had our fair share of digital meetings in the past month, let me quickly guide you through the technical side. In the top right corner of your screen, you will find the control panel. Here you may adjust the audio settings and choose between your headset or the computer audio. Please note that as an attendee, you are muted by default, so you may enjoy a sip of coffee anytime you wish without anybody noticing. A little further down on the dashboard, you will find the question panel. Please insert all your questions or comments here for us to take care of. You may do so anytime during the session, as it will neither cause irritation nor disruption to the program. We will note all your questions and attend to them in the Q&A at the end of the session. As to the schedule of this webinar, we will start with the current challenges on transfer pricing and the available guidance thereon, and continue with a practical approach to benchmarking in times of COVID-19. We will round up our session with a Q&A for you to submit your individual questions. Please note that this webinar is being recorded and will be made available online for you or your colleagues to recap anytime you wish at your personal convenience. It is my pleasure to have my valued colleagues Priya Selvanathan and Rödl Samuel on board as expert speakers. Looking forward to a most enlightening session. I now gladly pass on the mic to Priya. Priya, the stage is yours.
Thank you, Bettina. Thank you. So good morning or good afternoon, depending on where you are. And thank you for participating in today's session on the impact of COVID-19 on transfer pricing documentation and benchmarking. So the impact of COVID-19 has been profound. I mean, throughout the last 1 year, we've had many talks about COVID-19, the impact on your business, on transfer pricing. So this is, again, another one of those talks. But hopefully it will be a bit more targeted in terms of determining your arm's length pricing and how you can deal with such challenges. So many businesses have had their businesses directly impacted by the pandemic, from starting with disruptions to your global supply chain and possibly even your profitability, to changes in consumer behavior arising from lockdown measures in the beginning and government restrictions, some of which are still happening. For multinational groups, there has been the additional challenge of benchmarking your intra-group transactions to set transfer prices. And so today I'll be taking you through some of these challenges that arise from setting or changing your transfer prices due to the business changes due to the pandemic, and how you can respond to these challenges and then in the end build a defensible transfer pricing documentation and benchmarking analysis. So on this slide, you will see our agenda for today. So I will start off with a brief introduction, and then I will spend a bit of time taking you through the OECD guidance, where I will briefly share, and then where I'll briefly share some insight from some countries within the Asia Pacific region, namely Singapore, Australia, and New Zealand, that have issued their own guidance on dealing with such transfer pricing matters during the COVID-19 pandemic. After that, then I will hand it over to my colleague Samuel, who will then take you through some case studies and illustrate how a benchmarking analysis can be carried out during such an unprecedented time. And finally, to wrap up, I will share a summary of certain things for you to consider as you move out of the pandemic situation and how you move around it. Can I have the next slide, please? So before we get started on some of the details of how the impact of transfer pricing on your intercompany transactions and benchmarking during COVID-19, let me just set the scene here just to give you a brief overview of what transfer pricing generally means in a nutshell. So the concept of transfer pricing is generally related to related party transactions, meaning that if there are transactions between companies within the same group, or between associated persons, or a director and company, or the shareholder and the company, these would then be considered as related party transactions. And as you can see on the slide, this could generally mean, if you have any services between each other, any sale of goods, loans, any intangibles. These are generally some of the forms of related party transactions that we generally see. And from a transfer pricing perspective, a transfer price effectively should not differ from the prevailing market price, which would mean that the price reflected in a transaction between independent parties. So in simple terms, the price which you charge an unrelated party should be the same price at which you charge your related party. So how would then related party transactions, and in turn your transfer prices, impact your business during the current economic situation? Well, that's essentially what we're going to be discussing today. So moving on to the next slide. So we already know the impact of COVID-19, and it has been very far-reaching. So the rapid spread of the virus caused governments to react very quickly in pretty much a year ago. So, and this led to travel restrictions, government-imposed lockdowns, and then that led to supply chain disruptions and then unprecedented business disruptions globally. So as a result of these disruptions, it caused the global economy to shrink. Many enterprises have had their cash flows impacted, and as a result, it also impacted then their profitability. So due to the travel restrictions and government lockdowns, many industries also saw their business effectively shuttered. So certain industries, for example, those in the tourism sector, the F&B sector, have been really impacted by the travel restrictions, by the lockdowns. So these travel restrictions also led to some significant supply chain disruptions. So enterprises across a variety of industries face disruptions to their supply chains. So during the height of the pandemic, where there was effectively a global lockdown, limitations on business operations, and a closure of factories, this caused effectively a backlog of orders. And during this time, the movement of cargo at ports was also restricted. So this caused an increase in the cost of shipping due to the limited movement of air cargo. So the limited supply of cargo also caused an increase of logistical costs. And while certain industries also saw a lower demand, while other industries, on the other hand, saw a sudden increase in demand of their products. For example, players in the medical and medical equipment industries saw a sudden increase in demand, so exponential increase in profits. And on top of that, the market for online video conferencing services also saw an increase in demand due to work from home measures that were implemented. So as I mentioned earlier, some other industries then on the flip side of that also saw a significant reduction in demand. So, and as a result of these supply chain disruptions and changes in the consumer demand, multinationals have had to change their behavior to weather the storm of the pandemic and as well to survive. So as a result of these changes, multinational groups have had to change their intercompany arrangements. So, and this is where the transfer pricing implications come about. When a multinational group changes their intercompany arrangements, the transfer pricing models that were used to set the transfer prices during the times of economic certainty may no longer be applicable during times of economic uncertainty. What was once arm's length may no longer be arm's length now in such a situation. So in this situation, how is then a business expected to deal with these issues? Next slide. So during times of economic certainty, the arm's length principle has generally served as a key reference point for assessing intercompany prices. However, in times of economic uncertainty, such as during this pandemic, there are generally practical difficulties in applying the arm's length principle. So on this slide, I'll illustrate a little bit more detail on the transfer pricing implications arising from some specific related party transactions. So let's look first at intra-group services. So this could be impacted due to the restriction of movement or lockdown measures. The travel restrictions could have resulted in an entity within a group not receiving a intercompany service, for example, maybe a management support service, a management support service, or any other kind of intercompany support functions that was previously agreed and had already been documented via intercompany service agreement. Or the entity receiving this service now, because of the lockdown measures, does not need to receive such a high level of service, instead receives less support, or on the other side could maybe require now more support, so maybe more IT support. So in such a situation, should your related entity then be compensated in a similar manner as it was pre-pandemic? Or should the compensation be changed due to the changes in the circumstances? You would then have to revisit the benefits test and ask yourself this question: is the price you are paying for a certain intercompany service commensurate with the benefits you receive? Has there been any change pre-pandemic and during the pandemic? How do you then analyze and document such changes? There may also be a need for you to look into renegotiating and repricing some of these intercompany arrangements. What's important to consider is, again, we come back to the concept of arm's length. We will keep coming back to this concept of arm's length throughout our presentation today. Would a third party naturally renegotiate a contract? Is that a possibility? Or would they just reprice their arrangement? So these are things that we would need to look into when we have changes in our intercompany transactions as well. With regard to intercompany financing, a company within a group may be facing certain cash flow challenges, resulting in it needing additional financing. How would you price these financing arrangements if you have an intercompany, if you have an existing financing arrangement? Is it possible for you to revise the repayment terms and the interest rates? How do you then ensure that these financing arrangements are done at arm's length? And finally, with regard to intangibles, we would need to look at whether there have been any changes to the intangibles, and specifically we would need to look at the DEMPI functions. So DEMPI basically means that it's basically an acronym for development, enhancement, maintenance, protection, and exploitation. DEMPI is designed for ensuring that the allocation of returns from the exploitation of intangibles and the allocation of costs that is performed by compensating multinational groups is based on the appropriate allocation of functions, the assets, and as well as the risks. So during the pandemic, it is important to ensure that if there has been any change in the DEMPI functions, if there's any change in the functional profile, that these costs and benefits are properly allocated and compensated. What is key here is, of course, how you document any of these changes. Next slide. So having looked at some of the issues with regard to intercompany transactions, we now look at what this really means. So essentially, the issues arising from the changes in your intercompany arrangements is the application of the arm's length principle. One of the main challenges is the issue with carrying out a benchmarking analysis. The more wide-reaching the effect of the economic crisis, the harder it is going to be to find appropriate comparable companies and comparable transactions. There is, of course, also the issue of timing of the information and the availability of data. You may need to consider if your benchmarking strategy should remain the same, or if you should consider to change your benchmarking strategy. If you currently use a multi-year approach, would this still be suitable to generate reliable, comparable information? However, is this appropriate if the multi-year approach still includes only pre-pandemic data, for example, prior to 2020? Because 2020 data is still not available yet. And finally, is it also possible to use statistical models to predict arm's length margins? And another important question to consider is whether, even if you can use statistical models, whether this will be accepted by tax authorities, especially tax authorities within the Southeast Asian region. So there's a lot to consider whether these models will work and whether they can help to defend your position with the authorities. And one of the critical aspects of substantiating these changes to your intercompany arrangements is, of course, to ensure that your documentation is robust. It is very important when you have any changes to your intercompany arrangements that these be documented, and these have to be documented properly. So, however, especially during a time such as this, it is not easy to document these changes given the limitation of data. So, of course, there's many challenges that you will face. So, the unpredictability of these events due to COVID-19 could have a material impact on the material assumptions that you take to conclude your intercompany arrangements. So there could be unforeseen margin volatility and an inability to perform certain functions or carry out certain risks that may impact your already concluded contracts. How can you ensure that these contracts are carried out as it was set out, or is it then possible to invoke a force majeure clause? Do you even have a force majeure clause in your intercompany arrangements? How should you then document these changes? Is it possible, as I mentioned earlier, is it possible for you to renegotiate these contracts in light of the new operating environment? Would you then, when post-pandemic, when things go back, business goes back to normal, do you then have to renegotiate these contracts again? Has there been any change in the functional characterization of the enterprise? And if so, should all of these, should they be documented earlier rather than later? So the timing of the documentation is also very important as well. Can we move on to the next slide? So in response to some of these challenges, the OECD has on the 18th of December 2020 issued guidance on transfer pricing implications of the COVID-19 pandemic. The guidance covers 4 main issues, which I will discuss in a bit more detail after this. This guidance, while not law and is therefore not mandatory for countries to apply, is intended to help tax administrations and multinational groups to find a mutually satisfactory solution to transfer pricing issues and when performing transfer pricing analysis under such unprecedented circumstances. So some countries in the Asia-Pacific region, as I mentioned earlier, that is Singapore, Australia, and New Zealand, have also issued their own guidance on dealing with these transfer pricing issues arising from the COVID-19 pandemic. And I will also get into that a little bit more later. So next. But first, let's discuss the OECD guidance in a bit more detail. So the OECD guidance addresses 4 main issues, and that is number 1, the comparability analysis. Number 2, losses and the allocation of COVID-19 specific costs. And the third one would be transfer pricing issues arising from government assistance programs, such as your stimulus packages. And lastly, advanced pricing arrangements. So looking at comparability analysis, the unprecedented change in the economic environment following the pandemic has created a unique set of challenges for performing comparability analysis. The OECD guidance considers that the impact of the pricing between independent parties and reduces the reliance on historical data when performing a comparability analysis. So some of the challenges that are associated with performing a comparability analysis could vary depending on the impact of the pandemic and the economically relevant characteristics of an accurately delineated transaction. For example, if a controlled transaction is covered by a pre-existing intercompany arrangement, there may be no need to perform a new comparability analysis in 2020 if the facts and circumstances of the accurately delineated transaction has not changed. So effectively, if the facts and circumstances surrounding the transaction has not changed, it may not necessarily be required for you to then change your intercompany agreement. However, a similar approach may not be appropriate if there is a change in the delineated transaction. So it is important to consider if there has been any changes in the economically relevant characteristics, including all the terms and conditions of the agreement. And what about the source of information? With regard to the source of contemporaneous information, the OECD guidance states that any form of publicly available information, meaning those from a commercial database, and as well as those regarding the effects of the COVID-19 on the business, industry, and transaction, can be used in the analysis of the transfer pricing policies. All relevant economic factors that affect the financial results should be considered to determine the impact of the pandemic. The rationale and evidence of any change, again, of course, should be documented as part of your comparability analysis. Another thing that you will hear us repeating very much today is, again, documentation. So documentation is very important in how you have a robust documentation and how you can defend your position later on. Again, having a comparison of budgeted results against your actual results. So this will help to allow an approximate of the effects of COVID-19 on your revenue, on your costs, and therefore on your margins. It would demonstrate the financial outcome that would have been achieved, but for the impact of COVID-19. So to have a comparison of your results, of your budgeted results, and then your actual results, and then to also have perhaps a comparison of your results pre-lockdown, during lockdown, post-lockdown, to see what the financial outcome would have been achieved, but for the impact of the pandemic. With respect to timing, however, the contemporaneous information may not always be available. So information from commercial databases, for example, are usually only available after the event, so at a later time. For example, for FY 2020, data may only be available towards the middle of 2021. And in normal circumstances, taxpayers can use historical data to set prices because your economic circumstances and business circumstances are the same. So in this circumstance, the OECD guidance states that taxpayers will need to base their analysis on prior year data while utilizing current year data to whatever extent is possible. However, the downside to this is using data from preceding years without considering the specific impact of the pandemic may not result in a reliable benchmark. So the guidance does recommend tax authorities and taxpayers to apply some certain level of flexibility in determining the arm's length outcome. For example, tax authorities that normally use a price setting or an ex ante approach could consider using an outcome approach or an ex post approach to take into account information that becomes available only later on. Another consideration that was brought up in the OECD guidance is the use of prior economic or financial crisis to support the price setting. However, this is not a recommended measure as it will give rise to some comparability issues due to COVID-19 being a rather unique and unprecedented nature. So we are also of the view that this approach will not really be viewed favorably by most tax authorities. And some of the other comparability issues raised by the OECD guidance includes price adjustment mechanisms. So this is where prices for the current year would be adjusted in a later period when more accurate information to establish the arm's length prices becomes available. This approach generally may not pose an issue unless certain tax authorities generally don't allow for a year-end adjustment or a post-year-end adjustment. In addition to this, you will also, even if it is allowed, you will need to consider if there's any indirect tax issues, whether you would need to do a corresponding VAT or GST adjustments, whether there's any other customs duty issues that could arise as well. And then we also need to look at evaluating of the comparable set. So where companies roll forward their existing set of comparables, a review may be necessary for you to validate whether this set of comparables can be continued to be used and whether a revision to the comparable set is required. What about loss-making comparables? So most tax authorities within the region generally don't accept the use of loss-making comparables in the benchmarking set. However, it may be worth evaluating if loss-making comparables now satisfy the comparability criteria, and it may be appropriate to now include these loss-making comparables when the accurate delineation of the transaction indicates that those of the comparables are reliable. Another consideration to make is if the same set of companies were used pre-pandemic, they should not automatically be rejected now, just simply because they are loss-making due to the pandemic. So looking at the second pillar here, losses and the allocation of COVID-19 costs. So during the pandemic, many multinational groups incurred losses due to the decrease in demand or an inability to obtain or supply products or services. And as a result, they incurred maybe some exceptional or non-recurring operating costs. So in general, the allocation of risk is relevant in determining how losses are allocated between related parties. So the OECD guidance states that it's necessary for you to determine the commercial rationale and any change in your risk profile before and after the pandemic. With respect to limited risk entities, it's generally expected that such entities don't make losses. However, we need to remember that limited risk entities are not no risk entities. And the pandemic is indeed an unprecedented event. So as such, it's necessary to consider the specific facts and circumstances when a limited risk entity can incur losses. It may in fact be possible for a low risk entity to incur losses in the short run. And this has also been documented in the OECD guidelines. However, it may then not be acceptable if a limited risk entity continuously year after year incur losses. In such a case, you should then relook at your functional and your risk profile and to relook whether this entity is indeed or is in fact a limited risk entity. And as a result of the pandemic, companies may have incurred exceptional costs or any non-recurring operational costs. For example, this includes the purchase of PPE for your employees, whether you have renovated your office space to ensure that you can maintain physical and safe distancing between your employees, additional IT infrastructure, for example, or any additional logistics costs. So with respect to the allocation of such exceptional and non-recurring costs, these costs should by right be allocated based on an assessment of how independent enterprises under a comparable circumstance operate based again on an accurate delineation of the transaction and also on an analysis of the risk assumed. As such, an understanding of how independent enterprises carry out such transactions may reflect such costs in an arm's length price and how such costs may impact prices charged in related party transactions. In performing a comparability analysis in such a case, you need to consider how such costs are taken into account. Generally, such costs would be excluded from the net profit level indicator, except when it can be accurately delineated. So the exclusion here should be applied consistently with the tested party and the comparables. Some practical difficulties here. This would include the availability of having sufficient data of the comparables to allow you to exclude such exceptional costs, because we may not have the detailed breakdown of the comparable company's profit and loss statement to allow us to exclude some of these costs. Finally, we look at force majeure. In response to the pandemic, the independent parties could seek to renegotiate certain terms of the agreement. Can this also apply for related party agreements? An analysis of the economic circumstances of the commercial arrangement is relevant to determine whether the arm's length price a party would decide to invoke a force majeure clause. And now we look at the third pillar on government assistance program, or the stimulus packages. And in Malaysia here, since the start of the pandemic, we've already probably had about 5 stimulus packages to date. So there have been quite a few of them already. And I think most countries in the region have also had at least 1 or 2 stimulus packages being announced by the governments. So the availability of such programs could also potentially have a transfer pricing implication. So the terms and conditions of these programs related to COVID-19 needs to be considered when determining any potential impact that they could have on your related party transactions, and when you compare the effects with those of other pre-existing assistance programs. So it's necessary to consider if the government assistance is an economically relevant characteristic. If so, it should then be included in the transfer pricing analysis. And when you carry out a comparability analysis, it may be necessary to take into account the receipt of this government assistance when reviewing your potential comparables. So again, do your potential comparables also receive similar benefits or government assistance as well? So this will be necessary to try to determine how the open market transactions could be influenced by the receipt of government assistance. The receipt of government assistance could also reduce the quantitative negative impact of risk. For example, a party assuming a credit risk could expect to incur losses from a transaction due to financial difficulties of its counterparty. However, due to government assistance, the counterparty may now be able to meet this obligation. So these things should be factored in when you determine your risk allocation. So under the OECD guidelines, government assistance alone is not a factor to change the allocation of risk in a related party transaction. But it is now important for you to distinguish the government assistance during normal economic circumstances and during COVID-19 economic circumstances. And finally, we look at the last pillar here, which is on the advanced pricing arrangement. I won't go into too much detail on this, but the OECD guidance addresses some of the issues relating to advanced pricing arrangements. Some of the key areas that are discussed is whether there will be any material changes to the economic conditions arising from COVID-19 that would impact APAs that are already in negotiation. With regard to existing APAs as well, whether the terms should be respected, maintained, and upheld, unless there are conditions that could lead to the cancellation or the revision of the APA that is considered as a breach of the critical assumption that has incurred. So the OECD guidance states that a mere change in the business results due to the pandemic should not result in a breach of the critical assumptions. So here, the taxpayers and the tax authorities should adopt a constructive and collaborative approach with regard to the APA process rather than a unilateral approach, because in practice, it's likely to be difficult for taxpayers and tax authorities to conclude APAs during this pandemic period. So we can move on to the next slide. So as mentioned earlier, the Singapore tax authorities have issued their own guidance in dealing with transfer pricing issues. So other countries in the region have not done so yet, and it's not known if they will. The Malaysian tax authorities have said that they will not be issuing their own guidance and they will rely on the OECD guidance. But Singapore issued their set of guidance on the 7th of September and addresses two key aspects, and one relating to the transfer pricing documentation and the second on APA. So the details of the Singapore guidance is set out on the slide, but in general, the Singapore tax authorities will allow for the application of term testing without prior consultation with IRAS, so that's the Singapore tax authorities. Pre-pandemic, term testing was only allowed with prior consultation with IRAS. And in this guidance, IRAS will also allow generally for the use of loss-making comparables if it satisfies the comparability criteria. So it mirrors what the OECD guidance says as well. One of the key aspects here is documentation requirements. So if you see on the right-hand side of my slide here, it lists out the additional information that is set out in the Singapore guidance on the additional information and documentation that is needed to substantiate any changes or any businesses that have had their operations affected by COVID-19. And on the next slide, we have the Australian guidance here. So the ATO has issued their guidance on the 19th of June using via two separate publications. So the first publication addresses mainly the COVID-19 impact on transfer pricing arrangements, while the second publication highlights any changes to the related party arrangements. So these documents aim to assist taxpayers that have been affected by COVID-19 when preparing their documentation and how to support their arm's length pricing. And the document relating to the changes in your related party arrangement also states that the ATO is aware that there are certain communications suggesting that tax advantages by changing related party arrangements during the COVID-19 environment. So the ATO will review these changes or any changes to your related party transactions during COVID-19 by examining your documentation and assessing compliance with the Australian transfer pricing rules and also the anti-avoidance rules. So what this means is merely that you should not be changing your transactions merely to obtain a tax advantage with the excuse, using the excuse of COVID-19 and the changes and economic changes surrounding COVID-19. Next slide. Finally, we have here the New Zealand guidance, which the New Zealand tax authorities have also issued their own guidance. The New Zealand guidance, in comparison with the Singapore and the Australian guidance, is rather general and does not address many of the more technical matters on the application of the transfer pricing methods and the application of the arm's length principles. The guidance is, as mentioned, is rather general and is also supplemented by the OECD guidance as well. This is mentioned in the guidance. It does, however, highlight the information and documentation that taxpayers should include in their documentation to document these changes. And again, this can be seen on the right-hand side of my slide. So as mentioned, while many countries have not issued their own guidance, the OECD guidance should guide taxpayers and also tax authorities on dealing with some of these issues to a certain extent. Okay, so now that I've gone into quite a bit of detail on the transfer pricing challenges and the guidance from the OECD, I'll now pass it over to my colleague Samuel, who will then be sharing some practical aspects on the benchmarking analysis.
Yeah, hello. Thanks, Priya, for your insightful material. And good afternoon and good morning, everybody, depending on where you are. And thank you for participating in this webinar event. And before I start my topic, and as an introduction and a bridging, I would like to take us back into the comparability analysis before I start the explanations on adjustment approach. So I would say the comparability analysis itself is the heart of transfer pricing analysis or transfer pricing study. So if we quote from the OECD TP Guidelines 2017, paragraph 1.33, the definitions of the comparability analysis is a comparison of the conditions in a controlled transactions with the conditions that would have been made had the parties been independent and undertaking a comparable transactions under comparable circumstances. So there are two aspects in comparability analysis. The first one is identify the commercial or financial relations between the associated enterprise and the conditions and economically relevant circumstances attaching to those relations in order that the control transactions is accurately delineated. And then the second one, to compare the conditions and economically relevant circumstances of the control transactions as accurately delineated with the conditions and the economically relevant circumstances of comparable transactions between independent enterprises. So out of the four main issues on the OECD TPG in COVID-19, I will discuss more on the comparability analysis. So what does comparable mean? To be comparable means none of the difference, if any, between situations being compared could materially affect the conditions being examined in the methodology, or that reasonably accurate adjustment can be made to eliminate the effect of any such differences. So, and I believe some of my explanation already mentioned by Priya before. So the main issues in the comparability analysis under the COVID-19, let's say in the present times, most likely the available data for the comparable companies are only up to 2019, or in the case of multiple year analysis data utilizations, usually we would use, let's say, 3 years weighted average, which span from 2017 to 2019. However, depending on certain jurisdictions, there are some local tax authority that regulate for its corresponding taxpayers to prepare the TP documentations on a certain deadline. So the OECD says in the OECD TP guidelines, in COVID-19, information relating to the conditions of comparable uncontrolled transactions undertaken during the same period as the controlled transactions, or we would rather say contemporary uncontrolled transactions, is the most reliable information to use in a comparability analysis. And then we could conclude that the utilizations of 2020 financial data of independent companies is better. However, there are information deficiencies. So the OECD suggests some practical approaches to overcome the information deficiencies. The first one is to use the reasonable commercial judgment supplemented by contemporaneous information. And then the second one, an ex-post testing approach or the outcome testing approach. And then the third one, the use of more than one transfer pricing method. So in this slide, as you can see, or I would rather say the use of reasonable commercial judgment supplemented by contemporaneous informations as one of practical approaches to overcome information or comparable data deficiencies. So in this adjustment approach, we have to note important key points. The first one is about the utilizations or the using information that becomes available after the close of taxable year in filing returns, let's say up to 2019. And then the second one is, of course, about the perform appropriate adjustment to compensate the COVID-19 circumstances. And then we also have to consider these things on adjustment, whether to adjust the tested party on the comparables and rely on notable source, let's say for based on respective industry, associations or bureau for economic insight. And then about the extraordinary cost allocations. And then the last one, the government contributions or subsidies. And please move to the next slide. Thank you. So in this current slide, we will show you some adjustment options that can be used in the adjustment approach. But I also will highlight its strength and weakness. So for the first one, in the retrospective, so this adjustment is based on historical data. And for each set of comparable companies, reference value from a past economic crisis are used to draw conclusions about the possible effects of the corona crisis. However, the increasing lack of acceptance by a local tax authority, because some of them might also have the perspective of every crisis is different. And then the next one, the economic analysis or operating leverage. This adjustment is via business key figures. Or in short, we could say we put the tested party and the comparable companies in the same board, and then we identify the key figures or the COVID-19 impact on the financial account, and then we adjust to increase the comparability, degree of comparability. However, with an increasing number of tested parties, there is a high effort, and also subjectivity analyses are easily challenged by the tax authority. And then the third one, it is related to the statistical model. The development of a statistical model makes it possible to estimate the forecasting effect of various economic indicators based on historical data. This estimate can be used to adjust the range of results based on indicator values observed in 2020. However, it is regularly weak significance due to the high complexity in the calculation can lead in difficulties in understanding and also might be resulted in rejections from local tax authority. And then the last one for the prospective. This is adaptations of benchmark range based on industry analysis. And in short, I would say in this adjustment option, we will rely on the benchmark commercial database to generate some forecast financial data to be used to adjust our interquartile range. Although these adjustment options focus on worldwide or regional industries, and actual and analysis estimates are objective, influencing factors and standard factors, and also it is maintaining existing arm's length analysis approach. However, many tax authorities still not familiar with this kind of adjustment. And then please move to the next slide. So yeah, out of those previous adjustment options that I mentioned, for this webinar, we will share example cases for statistical model and the prospective one. So in the statistical model, finding reliable new normal comparable could be challenging for transfer pricing practitioner during the COVID pandemic. The comparable obtained in normal situations could not be used since it would produce distort result. And also there is a time lag, let's say 2 years time lag, between the closure of potential comparable financial statement, which reflect the 2020 conditions, and its availability in public or commercial database. And to address such challenge, statistical model, for example, linear regressions analysis could be used to find association between revenue and costs. So the financial performance of the potential comparable in 2020 could be predicted. And as you can see in the current slide, we assume that we use an example for a distributor company, which has refined its search criteria and obtained a new set comparables, which is considered more reliable. For example, it also includes the loss-making comparable. But the latest data available in the commercial database for the new comparables is only up to 2019. The company uses TNMM. As we know, it is maybe the most often used methodology in ASEAN. And it also uses return on sale, ROS, as its profit level indicator. So for your insight or information, the formula of return on sales calculations as profit level indicator is by calculating the operating profit divided by the revenue. So as you can see, the new set comparable, it described in the green table. So the resulted interquartile range are ranging from the lower quartile 2.45% up to the upper quartile around 6.37%. Okay, please move to the next slide. Thank you. So we assume that in the 2020, the distributor company or the tested party revenue is expected to decline by 25% due to COVID-19. And based on this fact, the comparable based on 2019 data should be adjusted or can be adjusted. Firstly, the comparable company's revenue will be adjusted according to the 25% reduction. And then the other financial variable will also be adjusted using statistical equations or formula, I would say. Then the financial performance of the comparable set for the 2020 could be predicted as follows, with a lower interquartile range that resulted. So as you can see, the first quartile that initially in the amount of 2.45%, now it become minus 0.69%, and up to the upper quartile 3.40%. So this is all the explanation of example for statistical model. Please move to the next slide. Okay, thank you. And next, we will explain an example for the prospective adjustment options. So as you can see, in the starting point or the green table on the top, this is also, or we could also use the same example from the previous case, the said distributor company. This is the initial interquartile range that resulted, the normal one. So on the next step, we use commercial database, let's say S&P database. You can see in the red table in the middle, there are two of it. On the first one, we use the database to generate the 3 years financial data for the said comparable companies. So it spanned from 2017 up to 2019. And then on the last column in the 2017 up to 2019, it means we calculate the average from those years, from the 3 years. And then we get the first quartile in the amount of 1.9%, up to the upper quartile 9.6%. And then what to do next? We also generate the forecast for the 2020 financial data from the same commercial database. And then we will get, if you see on the right table, the first quartile or the lower quartile in the amount of minus 0.3% up to the upper quartile in the amount of 7.4%. And then we calculate the differences, and then we will get the deviation and the absolute number from the initial first quartile 1.9% to minus 0.3%. The absolute deviation amount is minus 2.3%. And then we convert it into the corresponding percentage amount on the right side. And then we are already almost get into the final step. So in the final step, we just have to convert the initial interquartile range in the green table, the first one. Let's say in the bottom table, the yellow one, the initial lower quartile, which 2.36%, it will convert it into 1.30% by converting based on the difference amount that generated on the red table, red table in the middle. And also, we also apply this for the second quartile or median, and also the third quartile or the upper quartile. So the initial upper quartile, which in the amount of 4.97%, it will become 2.73%. Okay, please move to the next slide. So as an introduction for the outcome testing approach, I would like to take us back to the OECD guidelines that OECD also suggests an ex-post testing approach as one of practical approaches to overcome the information or comparable data deficiencies. The OECD TPG described two approaches to identify and collect data required to undertake a transfer pricing analysis. The first is the price setting, the ex-ante approach, which use historical data updated to reflect any change in economic conditions through the date of the contract. And it is already explained in the previous slide. And then the second is an outcome testing approach, which may incorporate information that becomes available after the close of the taxable year to determine arm's length conditions and report results on the tax return. So in the outcome testing approach, let's say in the present times, the financial data for the 2020 comparable companies might become available, but not complete. So the taxpayer is expected to perform an additional screening. So in the use of 2020 financial data of comparables, there are 4 key points that need to be noted. The first one, whether we should revise our search criteria. And then the second one, whether we to accept the loss-making comparables. And then the next one, to review the geographic locations of the comparables. And then the last one's the use of full range or 2-key range. And the OECD also quote, these options only applies if allowed by tax authority of the relevant jurisdictions. And for jurisdictions that adopt price setting approach, these options only applies on a temporary basis during the pandemic. And also tax authority could provide flexibility to allow amendments to FY 2020 tax returns regarding the applications of the arm's length principle. This is also already mentioned by Priya previously. So in the current slide, the outcome testing approach, there are 3 points to sum it up. Let's say in the application of the this approach applies only temporary basis for countries with price setting approach. Let's say for Indonesia, because in Indonesia we use ex-ante approach, so we use historical data or the comparable data that available before or at the time of the related party transactions is conducted. And then this approach also applies only when allowed by tax authority per jurisdictions. As we know, different jurisdictions have its local transfer pricing guideline. And based on the OECD, the tax administration also expected to provide flexibility to allow the amendment for the 2020 tax return. So the transfer price are set on an arm's length basis and using the available information. And then please move to the next slide. Now, this is the last part of my material, the evaluating of comparable set. Or in short, I would say we could say this as a roll forward. Maybe some of you already familiar with the terms, but in short, the roll forward means the taxpayers in TP practice usually tend to use the same comparable as stated or used in the previous TP doc last year. So in these sections, I would like to highlight a few things where a taxpayer rolls forward an existing set of comparable to cover the 2020. It may be necessary to review the suitability of these existing comparables, and potentially in some cases, it may be useful to revise the set based on the updated search criteria. So the next 3 points that I would like to highlight. The first one is determine the most relevant comparability factor given to COVID-19, assuming the geographic locations. And then the second one, to relax other comparability criteria to refine the sample. And then to also, for loss-making comparables that satisfy the comparability criteria in particular case should not be rejected on the sole basis that they suffer losses in the periods affected by the COVID-19 pandemic. So I think that's all from my material, and I would like to give the stage back to Priya.
Thanks, Sam. Can we go to the next slide, please? So just one final slide, just before we wrap up very quickly. So we've already discussed in detail over the last hour how the COVID-19 pandemic can impact your transfer prices and how you can ensure that your documentation and your benchmarking is now properly done and how it supports the impact your business has faced due to the pandemic. So as just a very short summary, what you should consider doing, of course, is to, number one, assess the impact from both a group and a company angle, evaluate the solutions to address the impact for the group and also for the company, but be practical when considering any changes to be made, taking into consideration, of course, your functional characterization, your risk profile. So be practical and focus on some of the more important measures first, and then in the longer term, look at all the other intercompany arrangements and how it impacts in your group's value chain. Secondly, consider if you need to amend your intercompany agreements, and more importantly, consider if these amendments are in fact necessary. So intercompany agreements should not be a one-page document. I think we are past the point of having such intercompany agreements. They are not accepted. They're very hard to substantiate with the authorities. These documents should accurately indicate and delineate the functions and the risks of both parties involved. Number three, prepare a strategically defensible transfer pricing report that includes any changes in the functional profile, any changes in the characterization. Include information, budgeted information, and actual information to support the but-for COVID-19 argument. So document any changes in your benchmarking analysis, also include pre-pandemic information during pandemic, and if necessary, what you expect the results to be post-pandemic. Number four, monitor the measures implemented and analyze the impact post-crisis and adjust these if necessary. And finally, number five, ensure that your documentation is defendable in the event of a transfer pricing or a tax audit. You should have the measures in place now rather than later, because it will be much harder to put in place documentation 2 years down the road. No one will really remember what's happened 2 years down the road. So have all these things in place now. With some of these measures, some of these recommendations by the OECD, and some of the recommendations that we've made today, it is very much possible to start creating your documentation, start creating these supporting facts that will help you in the event of an audit down the road. So as a final point, it is very encouraging to see the OECD guidance and the guidance that has been issued by certain countries like Singapore, Australia, and New Zealand. That reflects a recognition that the COVID-19 is in fact an outlier event, and it has impacted the transfer pricing models and businesses around the world. So like I said earlier, most countries, with the exception of these 3 countries, have not issued their own guidance, and it's not likely that they will. But it is good guidance nonetheless and can be applied. In Malaysia, for example, the Malaysian tax authorities have said that they will not be issuing their own guidelines on COVID-19 for transfer pricing, but they will rely on the OECD guidance. The exception to that fact is that Malaysia has issued FAQs on how the APA process will work during COVID-19. So as a final note, you should, of course, analyze and document the specific facts and circumstances that will then help you support and defend your position in the event of an audit down the road, and just to make sure that you have all your documentation on hand. So with that, we will end our session today. I hope you found this session very helpful, and we will be very happy to take any questions.
Yeah, thank you very much, Priya. Thank you very much, Sam, for these explanations on a really complex topic, which is quite topical right now, because there are a lot of changes necessary to keep in mind and to keep in sight in order to be sustainable and safe with your transfer pricing models. So I'm happy to pass the first question on to you. Is there any specific suggestion for financial year 2020 master file preparation with regard to COVID-19 impacts?
Okay, thank you. So I think I will take the questions and answer it. So in regards of the master file documentations, so we mentioned earlier, every changes made into the intra-group arrangement should be documented. Let's say for the service arrangement, and then any arrangement related to the utilizations of the intangible, and especially for the changes in FAR within the group for constituent entity, we should also document it in the master file. And maybe the laws documentations will take much more than 3-pager, and we also suggest that master file and local file approach to complete each other, and if possible to include the recovery patterns. Yeah, I think that's all the explanation from me. Thank you.
Thank you very much. I'll have one more. Malaysian tax authorities require the use of range from median to upper quartile. Due to the economic downturn, is it possible to expand the interquartile range to include the lower quartile, or even the entire range from minimum to maximum? I hope you understood that right. I'm afraid.
Yes, I did. Thanks. I'll take that one. Yes. So in practice, the Malaysian tax authorities do expect that you apply the range from median to upper quartile. So they will generally disregard anything that is below the median quartile. And in fact, there are discussions that the authorities will actually are actually intending to put this into the Malaysian transfer pricing rules. There is no mention of whether you can use an expanded interquartile range, as in within the lower quartile, or even the entire range from minimum to maximum due to the pandemic. But having said that, I highly doubt that the Malaysian authorities will expect it, because I would expect that if the other adjustments are carried out, then we can apply those adjustments, and it's not applicable on the interquartile range itself.
Thank you very much. Sam, I think this one's for you, if I get that right. What about the application of CUP method for commodity transaction? Is there any concerns for TP documentation in regards of COVID-19? No, I think it's for Priya, I think. Or?
Yeah, I think
who will take care of it?
the questions and try to answer it. Thank you. So, in regard of the reliability of the applications, the CUP method for the commodity transactions in COVID-19 pandemic, so we could refer for some legal basis from the OECD TP guideline 2017, paragraph 2.18, maybe up to 2.22, and then the OECD quotes that the contemporaneous uncontrolled transactions is the most reliable information to use in the comparability analysis. So the applications of CUP in the commodity using the market quoted price or the contemporaneous data is already in line with the OECD guideline. And the reliability of the transfer pricing is also have to based on the accurate delineations on the transactions, especially in the pandemic or crisis, and also the comparability analysis. And some strengths in the application of CUP method for the commodity transactions. So it is also the most appropriate method based on the OECD TPG 2007. And also, as I mentioned earlier, the market quoted price, the contemporaneous uncontrolled transactions comparable, which most reliable, and also the segregation approach that would help us to avoid the undescribed factors due to COVID, and then also to avoid the TP controversy, let's say for the cherry picking comparable. Yeah, I think that's all the explanation from me. Thank you.
Thank you very much. So as far as I can see, we have one last question, which seems to go to Priya. How will the tax authorities view a contract manufacturer that incurs losses in 2020? Is there any issue?
Well, again, depends on tax authorities of which country. And I think, as I mentioned in my presentation earlier, contract manufacturers generally are low risk entities, so they're not no risk entities. So it is not necessarily wrong for them to incur losses if there are, certain economic factors that warrant the losses. Of course, if the loss making continues over a period of time, then again you may need to relook at your functional characterization and your risk analysis of the contract manufacturer and see, is this in fact actually a low risk entity? Because if it is actually not, then there could potentially be issues, and the authorities may seek to make certain adjustments at that point. But if it is simply arising because of the pandemic and because of certain outliers, because of the pandemic, then yes, there shouldn't be any significant issue if there were losses by a contract manufacturer.
Thank you very much. So this seems to be it for the moment. So I'd say thank you very much to everybody for attending and participating in today's webinar. Should any questions have been left unattended so far, please just drop us an email and we will be happy to liaise. None of your questions needs to be left unattended. We will answer everything coming in. As always, it will also be my pleasure to share the slides with you upon request, and the recording of the webinar will be made available online later on as soon as technically possible for you to recap or to share with your colleagues. So once again, thank you very much. Have a great day and do all take care. Bye-bye.
Thank you.
Thank you.